Hello, everyone. Thank you very much for joining us once again today. And we are discussing today value added tax. You know this, the latest public clarification number 33, it has been issued that if the supply is being made through the e-commerce medium, then reporting, Emirates-wise reporting has been changed. So we'll look into this. What is the revised Emirates-wise reporting and what is the reason behind this? What are the conditions that are required to classify the supply into the respective Emirates? We have not discussed corporate tax in this week, but we'll start from the coming week. But I'm thinking one more thing as well. For the future purposes, we need to change the name of our webinar. Instead of weekly webinar on the corporate tax or weekly webinar on the value-added tax, we are thinking to change it as a compliance corner, weekly compliance corner with the Chris Cooper. We will be discussing corporate tax, we'll be discussing value-added tax, we'll be discussing GoML, we'll be discussing CBCR, will be discussing ESR, all these regulations, all these compliance things that we'll be discussing in the respective webinars. So let's start the discussion. So what is the background for introducing this revised Emirates reporting? We all know this, that in the Article 81 of the UAE VAT law, it is written whatever the tax revenue, whatever are the administrative penalties, these tax revenues, these administrative penalties needs to be shared between the federal government and Emirates government. So this is the reason, since the penalties, since the revenue is required to be shared in between the federal government and the respective Emirates. So we need to identify how much revenue basically government will be sharing. We need, this is the basic for setting up Emirates-wise reporting. So since the revenue will be shared in between federal government and Emirates government, tax revenue and respective administrative penalties, so Emirates-wise reporting is required. I believe this is the reason behind this, that we need to do the Emirates-wise reporting as well. So in our previous VAT law, which has been revised till now, in the Article 72 of the law, it has been written that the record of all goods and services supplied by the taxable person or showing the goods or services supplied by the agent shall be kept in retained. So basically, they need to, whoever is the taxable person, they need to maintain the record. In Article 2 of the 72, Article subclause 2 of the Article 2 is very important, where they have mentioned this, where the taxable person who makes a taxable supply of goods and services in the state must keep the record to prove the Emirate. This is the reason basically. So here we have already discussed the need to share the administrative tax revenue and penalties in between federal government and provincial government, in Emirates government. In the Article 72 and subclause 2, they mentioned the need to the businessman, the taxable person need to maintain a record to prove the Emirate in which the fixed establishment related to the supply is located. Then they said, where there is no fixed establishment in the UAE, if any business has not any fixed establishment in the UAE, then the taxable person must maintain a record for the transaction to prove Emirates in which the supply is received. So it was written in the repealed VAT law. So we have discussed till now two things. First, with the administrative tax revenue and related penalties needs to be shared between federal government and the Emirates government. Two, I think this was the foundation. Based upon this, record keeping requirement was there as per the Article 72 of the law, repeal law, and it was said where there is a fixed establishment, we need to maintain record to prove the fixed establishment, and where there is a no fixed establishment, we need to maintain the record of the Emirates in which the supply is being received. The same thing was shown in the VAT return guide as well. Whatever they've written in the guide, they said the information should be identified by the Emirate in which the supply was made. For businesses with fixed establishment in the UAE, the supply should be reported in the Emirate, where the fixed establishment most closely connected to the supply is located. Fixed establishment most closely connected to the supply is located where we need to report the supply in the Emirates. For non-established businesses, the supply should be reported in the Emirate where the supply was received. So this is the previous requirement of the law. There is no change in this article. In the previous requirement, we have identified revenue, tax revenue, basically revenue and administrative penalties needs to be shared between the Emirates, and based upon this, there were requirement for the Article 72 of the law, and there is a requirement in the respective guide as well. The way there is a fixed establishment, supply should be reported in the Emirate in the fixed establishment very close to the place of supply. Where there is a no fixed establishment, supply should be reported in the Emirates in which supply is being received. This was the previous requirement of the law. Now the Article 272 of the law has been amended. When this Article 72 of the law has been amended, there is no change in the Article 1. Article 1 is same. There is no change for this. Whatever we have discussed, they need to maintain the record. There is no change in the Article 2 as well. This is the same. Where there is a fixed establishment, they need to maintain the record of the Emirates where there is a fixed establishment is located. This Article 3, 4, this has been addition. So what has been written in the Article 3? This is the most important thing. So they written in the Article 3, where there is a no fixed establishment, then the taxable person needs to identify the place of establishment. So first they said fixed establishment. If there is a no fixed establishment, then there is this place of establishment. If there is a no place of establishment, then they need to see where the goods and services are being received. We need to report the taxable supply in the Emirates. So three things are there. First is a fixed establishment. Second is a place of establishment. And third, there is a no fixed establishment, no place of establishment. If there is a fixed establishment, we need to report the supply. We need to report the supply in the Emirates, which is the fixed establishment very close related to the supply. We need to report in this Emirate. In the fixed establishment, very closely related to that. If there is a no, then we need to look into the place of establishment. So where there is a place of establishment, we need to report. The law says basically the place of establishment in the state, he must keep records of the transaction to prove the Emirate in which the place of establishment is located. Where in this case, third case, there is no fixed establishment, there is a no place of establishment, then we say where these supplies are being received, it may be goods, it may be services, we need to report in the respective Emirates. So this is the general rule. They have introduced in the Article 72 subclause 4, now they have introduced the exceptions as well. This clause 4 is the exceptions of the Article 3 and Article 2. They said Article 4, if the value of the taxable supply made by a taxable person through the electronic e-commerce exceeded 100 million dirham during the calendar year, he must record the transaction to prove the Emirate in which the supply is being received. So this is exception. If the supply is being made through the e-commerce platform and the value of the supply exceeding more than 100 million in the calendar year, then we need to report the supplies in the Emirates in which these goods are, these services are being received. We'll discuss in the next slide. So for the time being, we have established fixed establishment. This is the general rule. One is a special rule. One is exception of the general rule. General rule is where there is a fixed establishment, we need to report in the respective Emirate. If there is a no fixed establishment, we need to report the supply in the place of establishment. Where there is a no place of establishment, we need to report the supply where these are being received. This is the general rule. As a special rule, as an exception to the general rule, they said if the supplies are being made through the e-commerce platform and the value of the supply is more than 100 million during the calendar year, then these goods and these services should be reported in the Emirates in which these are being received. In the Article 5, they have discussed what is electronic commerce. They said basically process of selling the goods and services through the electronic means. It can be website, it can be app as well. The different modes of electronic means we'll discuss in detail. Then in the Article 6 of the revised 72 subclass 6 of the Article 72, they have discussed the reporting requirement that we'll discuss in detail. So basically, just after this revision in the respective VAT regulations, they have introduced public clarification, and this public clarification only deals with this subclass 4 of the Article 72 of the UAE VAT regulations. So this public clarification number 33, it deals with the subclass 4 of the Article 72 of the UAE VAT regulations. It deals with the reporting requirements as well. It deals with the electronic. This is basically we'll discuss in detail. So if I'm summarizing whatever we have discussed till now, Emirates-wise reporting, we need to look into this. Supply is being made through the e-commerce medium. This is the first questions. Supply is being made through the e-commerce medium. Supply through non-e-commerce medium. If the supply is being made through the non-e-commerce medium, then we'll look into this. The taxable person has a fixed establishment. Yes, the place of supply will be Emirates, which close is the fixed establishment most closely related to the supply is located. Suppose if company is in Dubai, this is the only fixed establishment there. No other office in the UAE, and from Dubai they are making the supply in various Emirates. Since they have one fixed establishment in the UAE, so all sales needs to be reported in Dubai. Now, if there is no fixed establishment, place of establishment, what the difference between the fixed establishment and place of establishment? Fixed establishment is the place from where day-to-day business is being conducted. Place of establishment is the legal, where the entity is legally registered. So if there is no fixed establishment, place of establishment is most closely connected to the supply, then we need to report where the place of establishment is located. Where there is no fixed establishment, no place of establishment, then we need to report in the Emirate where these goods are being received, where these services are being received. This is the supply through the non-e-commerce medium. If this supply is being made through the e-commerce medium, now the question arises, might be the value of the supply that is being made through the e-commerce medium, the value of the supply is more than 100 million or less than 100 million. If the value of the supply is less than 100 million, this in the public clarification, they have given it name of non-qualifying registrant. They said this is a qualifying registrant. I am assuming this is a non-qualifying registration. If the value of the supply which is being made through the e-commerce medium, website, app, whatever discussed in detail, so this non-qualifying medium treatment will be 100% same like the supply through the non-e-commerce medium. So if the value of the supply is more than 100 million and this supply is being made through the e-commerce medium, then they have issued the public clarification number 33, and we need to report the goods, we need to report the services in the respective emirate where these goods, these services are being received. The place of establishment, I have just this place of establishment and fixed establishment. Place of establishment is basically where the day-to-day business, the legally entity is legally registered. Place of establishment where the business is legally established. Fixed establishment where person conducts other than place of establishment, there may be a fixed establishment as well, and from where the fixed establishment the person is conducting the business on regular and day-to-day basis. So this is the first priority for reporting purposes. This is the second priority for reporting purposes. We have discussed the background. The objective was basically to have a better control and oversight on the e-commerce transaction and respect of tax revenue. This is the reason that they issued the public clarification. The new reporting requirement in the revised VAT regulation, we know this, that as per the Article 72 of the law, if the value of the supply which is being made through the e-commerce business, if the value of the supply is more than 100 million during the calendar month, the reporting requirement, it needs to be reported in the Emirate where these supplies are being received. So this is the reason that they've issued the public clarification on this as well. So what is e-commerce? E-commerce is the process of selling goods and services through the following medium. These mediums can be electronic medium, these can electronic platform, store in social media, electronic applications. Electronic medium, it can be website, it can be portal, gateway, interface, platform, marketplace, API stores. All basically, if anything is being sold through the electronic medium, electronic platform, these are various electronic medium, these are various electronic platforms. So we'll say this is the e-commerce medium. Law has used the word qualifying registrant in the public clarification, not in the law, sorry, it has been used in the public clarification. Qualifying registrant, we have already discussed, if the supply is being made, the taxable person which is making supply through the electronics medium, e-commerce medium, and the value of the supply is more than 100 million, the person is called a qualifying registrant, and the reporting requirement for the qualifying registrant is different that we've already discussed in detail. But the important thing is the value of the supply that is being made for the e-commerce medium. If this person, if the taxable person here making a supply, some supplies out of the e-commerce medium, some supplies through the e-commerce. Important thing is we need to look into this 100 million. If this is being made, what is being supplied to the e-commerce medium? If the total value of the supply is more than 100 million, including the supply through the e-commerce medium, including the supply through the non-e-commerce medium, but the value of the supply through the e-commerce medium is less than 100 million, then this requirement of the law will not be applicable, because we need to look into this. Only supply through the electronic commerce shall be considered. If this increase more than 100 million, then if the person will be considered a qualifying registration, a respective requirement of the law will be applicable. General rule, we have already discussed. What are the general rule? General rules, first thing is a place fixed establishment. Then there is a place of establishment where there is a no fixed establishment, where there is a no place of establishment. Then the Emirates in which these goods or these services are being received. This is the general rule. And special rule, we have discussed the exception to the special rules. The exception is if the value of the supply is more than 100 million through the e-commerce medium, then it will fall under the exceptional rules. One person can have a mixed supplies as well. So mixed supply, they need to identify e-commerce supply more than 100 million, different, less than there are two categories. General rule, less than 100 million supply. This size, sorry. So this is there is a different criteria. This is a different criteria. We need to identify, in case of mixed supply, we need to identify supply under the special rules, supply under the normal rule, then we consolidate it. After consolidating, we need to report it in the respective Emirate. So this will be where these goods and services are being received. This will be close to the fixed establishment, place of establishment, or third category same. If there are no fixed establishment, no place of establishment, then these both will be same where these goods and services are being received. At the end, we need to identify the respective Emirate, and after identification of the respective Emirate, we need to consolidate the number and then we need to report it in the return. The amount on the VAT return under the box number 1 will be an aggregate amount of the e-commerce and non-e-commerce activities for each Emirate. Then we need to work it on, we need to identify it, we need to, after then we need to consolidate it, and after consolidating, we need to report the number in the return. VAT return for the mixed supply, that this thing we have already discussed in the diagram. Standard rated taxable supply in the UAE, standard rated taxable supply in the UAE, then sees the fixed establishment. Report in the Emirate in which the company's fixed establishment most closely connect to the supply is located. Where there is a no fixed establishment, then we need to identify the place of establishment. Company does not have a fixed establishment, then report in the Emirate in which the place of establishment in the UAE is located. Standard taxable supply is where company neither has a place of establishment nor a fixed establishment in the UAE, then report in the Emirate in which the supply is being received. Standard e-commerce supplies having a value of more than 100 million. Only e-commerce then report in the Emirates in which the supply is being received. So these are the reporting requirement as per the revised VAT regulations as per the public clarification number 33. So this is the criteria. How can we say that the goods and services are being supplied through the e-commerce platform, e-commerce medium? These are the four conditions. All these conditions, these are basically in overall, say we can say there are three conditions. This pertains to goods, this pertains to services. These are two common conditions. These are the in total three conditions, three for the goods and three for the services. What is this three for the goods and three for the services? First of all, goods and services are listed or advertised on the e-commerce medium. So if suppose there is a platform, on this platform goods are listed, from these goods you can go and check the prices, you can make an intelligent decision that you need to buy these goods or you should not buy these goods. This is providing sufficient information to take the decisions. Then it will be assumed that goods or services are listed and advertised on the platform. First condition. Second condition, the persons, the buyer, the customer can be able to make the orders. They will be able to make the orders on the e-commerce platform. This is the second condition. Okay, the consumer has seen the goods and services are listed on the platform, their price is coming, they can make intelligent decisions, sufficient information is there. Then they must be able to place the order online as well. Payment doesn't matter. Might be you are paying through the bank, might be you are paying through the e-commerce platform, might be you are paying through the cash, it doesn't matter. But they are asking you must be able to place the order through the platform. And all these terms and conditions should be there. What is the discount? What the term and condition, the delivery terms, all these conditions are the payment term, all these conditions are there. So if the goods or the services are listed on the platform, and if these goods and services can be ordered through the platform, it doesn't matter how the payment is being made. Third condition, they are saying if these are goods, these goods are being delivered at the address provided by the consumer. And if these services, then the right to receive the services is being granted to the end user without with the minimal human intervention, then we can say these goods, these services are being supplied through the e-commerce medium. These four conditions must be full for the three conditions for the services, three conditions for the goods. So if these conditions are being fulfilled, then we can say, okay, yes, the supplies are being made through the e-commerce medium. If these conditions are not being fulfilled, then we say the supplies are not being made through the e-commerce medium. And this, any supply which meets all these conditions and the value of the supply is more than 100 million, then we can say, yes, this is the qualifying registrant. Otherwise, we'll say the person is not a qualifying registrant. So this is the criteria for to classify the goods and services through the e-commerce medium, and these conditions must be fulfilled to qualify, as I mentioned, to qualify as a qualifying registrant. Undisclosed agent, there is a possibility, might be this is the electronics platform, there is a supplier behind this is a customer. If this supplier is supplying the goods and services or displaying the goods and services on the electronic platform, but the customer cannot see who is the actual supplier of these goods. The customer cannot see on the platform who is the actual supplier of these goods. Then they say it will be considered undisclosed agent. Because the customer doesn't know who is the actual supplier behind these goods. If the customer cannot see this supplier, then it will be assumed this is a undisclosed agent. In case of undisclosed agent, it will be assumed that the goods are being supplied by the supplier to the platform operator, and the platform operator is supplying the goods to the customer. So when the supplier is supplying these goods to the platform operator, the public clarification says the platform operator account for the VAT. Account for, I believe it will be subject to RCM, because they are using the word account for the VAT. If they are using accounting for the VAT, if they are accounting for the VAT, then whenever this platform operator is supplying the goods and services to the customer, this platform operator will issue tax invoice based upon by adopting the tax position, unless the goods are zero rated, unless the goods are exempt or out of the scope. So unless the goods are exempt, unless the goods are out of the scope, for the zero rated supply and for the standard rated supply, when this platform operator is receiving the good, the platform operator will apply a reverse charge mechanism. When these goods are being supplied to the end user, platform operator will charge 0% VAT, or platform operator will apply 5% VAT unless the goods are exempt and unless goods are out of the scope. So basically, if the customer cannot see who is the supplier behind the goods, it will be considered undisclosed agent, and the platform operator, it will be assumed that the platform operator is buying and selling. At the time of buying, they will apply RCM unless the goods are exempt or out of the scope. At the time of selling, they need to charge 5% or 0% VAT unless the goods are exempt or out of the scope. Incidental supply. So basically, if the platform operator, they are saying if the ancillary activity, incidental supplies, online transaction fall within the scope of electronic e-commerce of the goods that provided by the same supplier. The supplier who is supplying the good, the same supplier is supplying the services as well. So it will be assumed in the fall under the definition of e-commerce, and principles, we need to apply the principle of Article 4 of the UE VAT regulation. It will need to identify this is a single supply or composite supply. If on the invoice this is the one line item is coming, then we will say this is a composite supply. The two different line item are coming, it will be single supply. For the single supply, we need to assess the tax position of each element, each supply individually. For a composite supply, we need to apply the tax based upon the principal component of the supply. We all know this basically what is single supply, composite supply, how it needs to be reported on the invoice, how it needs to be reported in the return. Basically, if these goods, sorry, if these incidental supplies are being supplied by the same supplier and they are not showing as a separate line item on the invoice, then the taxation will be based upon the composite principal component of the supply. But if they are showing, okay, goods is separate, payment system separate, logistics separate, other similar platforms separate, then we need to identify what is the applicable provisions of the VAT law for each component. Might be this is 5%, might be like we know this payment will be might be 5%. Logistic, local passenger transport is 0 exempt, and local goods supply is 5%. We need to identify each component and each element individually. So what will be the tax position for individual element? So it is related to the incidental supplier. Then threshold for qualifying registrant. We have already discussed the threshold. Threshold is 100 million. To notify the FTA, this 100 million is only supplied through the e-commerce medium. And whenever they are doing notification, the registration is required to confirm the date when this 100 million threshold was exceeded at the time of submission, return and report. The first assessment is starting from the year 2023. We have already discussed this 100 million for any calendar year. If this 100 million is being crossed during the calendar year, we know this Jan to December. So first calendar year basic assessment is 2022. Each business, they need to identify each businesses who are making their supply through the e-commerce medium. They need to look into this. If the value of the supply is more than 100 million, then they will be subject to these reporting requirements. These are the reporting requirements. So basically, when the registrants have exceeded the 100 million during the calendar year 2022, their reporting will start from tax period starting on or after 1st July 2023, and it will continue for 18 months. For 18 months, they will keep reporting this. And if their threshold has exceeded after 2022, might be in 2023, might be in 2024, might be 5, might be 6, in any year, in any calendar year in the future. If their threshold is being exceeded in any calendar year in the future, then say the reporting requirement is 2 years, and this 2 year will be started from the first tax period after the date, first tax period after the date, calendar year commencing after the date the registrant has exceeded 100 million. I just wanted to give you an example for this here. Just look into this. This is 2022. If 2022 this threshold has been exceeded, then reporting requirement will start from 1st of July. Assuming their tax year is the first tax period is starting from 1st of July 2023. From 1st of July, 18 months till 31st December 2023, they need to report it in the return. So if they exceeded the threshold in 2022, they need to report it for 18 months from the tax period starting on or after 1st of July 2022, and 18 months will be ended, sorry, this is 2024. 18 months will be ended 6 months of 2023 and 12 months of 2024. This will be report 31st of December 2024. Now, if they've crossed the threshold in 2023 or in 2024, okay, if they've crossed the threshold in 2024 in any period, assuming they have crossed the threshold in Jan, Feb, March, April, May, December, it doesn't matter. If they have crossed the threshold in 2024, they said first tax period starting after the end of the calendar year. So first tax period starting after the end of calendar year. Calendar year will be end 31st December 2024. After the end of calendar year 2025. In the 2025 first tax period, assuming first tax period is starting from 1st of April. From 1st of April onward, 2 years, they need to continue the reporting and they need to perform this test. After at the end of 2 years, they need to again perform the test. 100 million threshold has been exceeded in the previous calendar year or not. If exceeded, then subject to same reporting requirement. If not exceeded, then they need to hold the reporting requirement. So I think everyone is clear. From my side, basically, whatever we have discussed till now, I'm going back to the same. I just wanted to highlight the same thing that we discussed. This diagram is very important. Emirates-wise reporting. First of all, we need to identify, are we supplying through the e-commerce medium? Are we not supplying through the e-commerce medium? If we are supplying through the non-e-commerce medium, we need to identify the fixed establishment, and we need to report in the Emirates most closely connected to the fixed establishment. If there are no fixed establishment, we need to consider the place of establishment. Where the place of establishment is located, we need to report the supplies in the respective emirate. Where there is no fixed establishment, no place of establishment, we need to report where these goods, where these services are being received. Then we need to look into this, if the supplies are being made through the e-commerce medium. If e-commerce medium supply is less than 100 million, if less than 100 million, same criteria like non-e-commerce medium. If this is more than 100 million, only supply only through the e-commerce medium is more than 100 million, then the person will be subject to reporting requirement, and they need to report in the Emirate where these goods and services are being received. Reporting requirement for 2022, 18 calendar months starting on or after 1st July 2023. And after this reporting requirement starting on or after end of the calendar year for 2 years from the commencement of the tax period starting after the end of the calendar year where the threshold has been exceeded. Okay, this is over from my side. I think everybody would be clear what is the reporting requirement, what is the reporting requirement for the e-commerce, non-e-commerce, normal business, in which Emirates they need to be. The big confusion in the market, very honestly, where they need to report the. We were always asking, basically, they need to report where the fixed establishment most closely connected to the supply is located. We were always advising very correctly to our clients. We have never ever gone through any of this. So basically, they have given a clarification. This is a very good thing. So if you have any question, you can ask me, you can ask Faiza, you can ask our manager, you can ask assistant manager, our team members. We are always we are ready to listen, ready to understand, ready to deliver. You can drop us an email info@crestcooper.com, or you can give us a call as well. Looking forward to your, thank you very much. So your question and answer, if I'm going through the question and answer, you said if PO is in Dubai, then PE can be different. If place of establishment is Dubai, then PE can be different. Permanent establishment can be different. Yes, the whole supply should be reported. Now, first of all, we need to identify. Law says, first of all, you need to identify the fixed establishment, permanent establishment, fixed establishment. Then you need to look in the place of establishment. First criteria for non-e-commerce having a supply, non-e-commerce or e-commerce having a supply less than 100 million. First criteria is you need to look into this fixed establishment, and you need to report in the Emirate where the fixed establishment most closely connected to the supply is located. If there is no fixed establishment, then you need to go to the place of establishment. Second, we have an IT consultant from India. We are paying him through bank transfer. Should this be reported in the VAT return? We have an IT consultant from India. You have an IT consultant from India, and we are reporting him through bank. We are paying him through bank transfer. Okay, IT services depend. These are the, I will discuss value of the service. The principle apparently should like this. Whenever you are receiving the service, definitely you will be VAT registered party. If you are a VAT registered party, you are receiving the services, you need to apply the reverse charge mechanism. But if these services again, and if these services, whatever you are receiving from the resident person who is a taxable person who is out of the UAE, in which Emirates you need to report it, basically it depends. Supplier has a fixed establishment, supplier doesn't have a fixed establishment, place of establishment. Suppose the person is sitting in India supplying the goods and services in the UAE. They don't have the fixed establishment. They don't have the place of establishment. Then they need to report in the emirate where your business is located, because you are receiving the goods and services in the respective emirate. In which emirate you are receiving these goods and services, you need to report it in the respective emirate. If your office is in Dubai, you need to report it in Dubai. If your office is in Abu Dhabi, you need to report in Abu Dhabi. Your office is in Sharjah, you need to report it in Sharjah. But as apparently it looks like this, that you are receiving the services, you will be subject to a reverse charge mechanism. Any other question? No? Okay, thank you very much and have a lovely day. Thank you. Thank you very much. Thank you. Bye-bye.